Good afternoon, everyone, and thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And on today's webcast, we will provide you with a brief macro overview. And of course, David Burrows, our Chief Investment Strategist and President, would be pleased to address your questions at the tail end of the conversation. So don't be shy. Email me at phastings@barometercapital.ca or hit me up on the Zoom chat. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you?
Great. Thank you. Nice to see you as always.
Well, it's funny. I tried to take a week last week with my family, and typically the middle of July would be easy to do that, but frankly, it was never really very far from the screen. So wasn't much of a break, but it was nice to be away for a few days.
For sure. Well, we're glad to have you back, and I know our audience is eager to hear your market update. So I'll let you take it away.
Sure. Okay. Well, here we are. We're in the middle of July. We are at the very beginning of earnings season. We are mid-stride with the Fed in its tightening cycle. And the market's trying to adjust to all of the changes taking place. And there have been lots of challenges for the market, lots of challenges for investors psychologically, geopolitical tension, a major inflation scare, and now I think real concern about the strength of the economic cycle. And one of the hardest things for investors is to square up where the market is in its adjustment process versus where the economy is in the economic cycle. And the hardest thing about all that is that it is rare that the market would be step for step with the economy. It tends to be, of course, that the market is discounting things as news comes forward as to what they think the market will be doing the economy will be doing in 6 or 9 months. So market is front end loading first in taking down the multiple that investors are prepared to pay. And then along the way, as concern around recession rises, what do we think earnings are going to be? So we're all anxious to hear what companies have to say about this most recent quarter, and more importantly, what kind of guidance they want to give as we go forward. So what I'd love to do today is just, again, we like to base things on the numbers and take the data as it comes. And we just have to make sure that our portfolios are lined up with what's going on out there in the market. We can't see around corners, but the market does have a tendency to be able to foretell where things are going. And so we want to understand the message of the market. So just as we always do, just to start with a top-down macro view, this is a very macro-driven market. It really is not a market where the market is sorting kind of good from bad as far as fundamentals, business to business. It's more asset class to asset class and sector to sector as people try and position for what they think may be coming. So we've been making a case that we believe we're in a structural bull market, and we continue to believe that. Structural bear markets tend to go on for a really long time, 13 or 15 years. They tend to be marked by very significant bear markets. And some might ask, well, what is the difference between a secular bear market, and a cyclical bear market in a secular or long-term bull market? And it tends to be one major difference, and that is that you definitely get recessions in a secular bull market. You have 4-year business cycles or something like that. But they don't tend to turn into going from a recession to some kind of a credit crisis. And of course, 2008-9 was a credit crisis that started out as a recession, and the excessive leverage led to a credit crisis. And we saw that coming in the behavior of the banks and credit markets. And it made us get very, very defensive. And of course, it went on for some time. Very similar problems in the early 70s with inflation. And that, again, was a major crisis. When in the early 1930s, as you went into depression, you came out of an incredibly hot period for the economy and a big blow off top in the market. And I don't think that those are the types of things that we're facing at this point, but we have to stay kind of open-minded. As it sits right right now, the bear market that we've seen is similar to what we see during a structural bull market. This is the S&P from 2013 to the present. This is the S&P, the early 80s and 90s. Very similar types of corrections along the way, and not to underestimate how painful they were. They definitely were painful. Some were longer, like 1990-91 recession. Some were shorter, but came after very sharp run-ups in the market, like the crash in 87. And some were just straight time, like 1994, which is actually quite similar to the period that we're in right now, because the Fed, that's the last time they raised rates by 75 basis points. Very sharp increases into the spring of 94. Market rallied a bit through the summer. It tested again in the fall, and the market wound up about flat on the year, but there was just a ton of correction that took place over the course of time. Of course, the reason that we want to try and discern between structural bear market and cyclical bear market is that what comes after them is really significant. You get 2 and 3 year run-ups that can be 80, 90, 100% before you get to the next one. And if we look at this current secular bull market, from the point where we broke out in 2013 to December of this year, about 105 months, a couple of 100% in return. We look at the 1980s and 90s. This is a full secular bull market, just about 1,200% return over about 200 months. So it's not impossible that this could derail. And certainly we've seen the fastest, most significant tightening in financial conditions that we've seen in a very long time. So there always are risks, but this would be an exceedingly short secular bull market. And I wouldn't put the odds very high that this is about to be derailed. We've made a case that we saw a generational low in rates, and the bond market, would be under pressure. And certainly after 40 years of falling interest rates, for the first time in this past year, we exceeded the trend down in rates, and in fact exceeded the highs in rates from 2019. This was a very significant run up in 10-year yields and 5-year yields and 2-year yields. We thought about a month ago probably it had run its course in the near term, and as people thought the economy might cool, bonds might have a bit of a bounce, so we took off our short position in the bond market. And I think people know we added fairly significant to shorter term bonds over the last 8 weeks. And that's just really a place to go with liquidity, to hold and wait for the opportunity to put that money back to work. As it turns out, yields have backed off a little over the last 3 weeks, and we're net back below sort of those peak levels from 2014 and 2018. The long-term trend is still lower and will have to catch up. So my guess is probably we've seen the highs in yields for the near term, and now we'll see what kind of economic slowdown we get. And certainly people will use bonds as a safe haven. This is the 10-year yield. It got as high as 3.45%, just about 3.5%, and sitting now at about 2.96, backing off a little. And we'll see where we go from here. But it looks like that major run up in yields in the near term on inflation fears is backing off, as the market believes that the Fed's aggressive policy will help to cool inflation. To be clear, the Fed does not have an interest in putting the economy into recession. What they do have an interest in doing is talking the bond market into weaponizing and trying to slow the economy and slow demand, so that we can catch up on some of these bottlenecks and get the supply chains back in order and get the inventories back in order. So maybe we take some of the heat off of inflation. Now, when we look at the TLT, the US long-term bond, a lot of carnage there over the last couple of years, down 39% at the lows. It's bounced a little. It's bounced about 7% off the lows from the late part of June. And so the bonds are a little stronger. The aggregate bond index is a little stronger also. We've been making a case that after a very long bear market in commodities, we're starting to see a relative outperformance in commodities versus stocks, and that this would be a relevant asset class over the next number of years. When we see these turns, they tend to go on for a long time, but it's not without corrections. And it's not without fits and starts, the same as rates. So what I want to stress today is the difference between a long-term view and a short-term tactical view. We may have a long-term view that commodities ultimately probably outperform equities for the next several years as we reflate the world's economy. But in the short run, we're going to have bursts where the economy slows down, where commodity prices back off. And what makes an uptrend, if you remember, is higher highs and higher lows, higher highs and higher lows. So we're pulling back over the last couple of months in commodity prices. It doesn't mean that this is all over, but it means that we take a breather and we reset. Just the same way as stocks. We've had 3 steps forward, we're having 1 step back. And that's what makes a secular bull market. So there's the RJI, equally weighted ETF, a basket of commodities, soft commodities, metals, and so on. This is the low back in 2020 and the COVID lows. These are monthly bars, very strong, broke the downtrend that had been in place since 2008, worked its way higher, and over the last 2 months is correcting. Now you'll see that the very long-term moving averages stopped going down and have flattened out and are turning higher, which means we've moved into an uptrend. But it doesn't mean that we can't pull back, and we have to take these pullbacks seriously. There's the short-term picture of the same index. You can see that we pulled back to the 200-day moving average. We bounced off it. We've pulled back again. My guess is, it's possible that we hold here. If the economic data or the Fed continues to be really hawkish, it could pull back some more. And again, within this commodities index, there's different pieces, some acting better, some acting worse. But at the end of the day, relative to stocks, the RJI index is up 16% on the year, where at the low point, the S&P was down 24%. So certainly it's pulled back and it's pulled back to trend. It's certainly correcting. But my guess is the outperformance versus equities on a longer term basis is not over. So we have to recognize the difference between a tactical period and a long-term trend. Crude, after making a very significant breakout over the last number of months, again is pulling back to the long-term rising moving averages. At this point in the short run, this afternoon was trading at $96 a barrel. Pulled back pretty sharply off $120 a barrel. There is a structural deficit in the market. And even in a recession, we might lose 1.5 to 2 million barrels of demand a day. But the structural deficit is greater than that. Our guess is that it holds somewhere in here. If we break $94, maybe we trade down to 90, or maybe we trade down to 85. And we have to adjust our holdings based on those corrections. But by no means do we think that this is the end of an energy bull market. The agricultural commodities have pulled back a little, but you can see a series of lower highs and lower lows. We bottomed in 2020, and from there, a rally, a pullback, a rally, a pullback, a rally, a pullback, a rally, a pullback, and we're in a column of X's. This is an uptrend, and it's a long-term uptrend. It may be correcting in the very short run, but that sets up the next opportunity. So commodities long-term look attractive. In the short run are retrenching and having to deal with expectations of a slower near-term economic growth path. But my guess is it will continue to be higher highs and higher lows. Copper, one of the most economically sensitive groups, 2 weeks ago on our webcast, we said, look, in the near term, looks like it's going to correct further. This was at $4. We're sitting down, come down a fair ways. But again, longer term looks quite attractive. Now, we build our portfolios based on process, not based on opinion. And we run our top-down models. And the top-down models look at all of the groups and sectors and themes that we could focus in and try to identify those that are seeing net inflows of capital, where we're seeing expanding breadth, where more and more securities are performing well. Sometimes there's a lot of buckets we could focus in, sometimes there's not very many. And day by day, that is constantly changing. So we always have a view from a top-down perspective, which groups we prefer to be focused in and which ones we want to avoid. From a bottom-up perspective, we're trying to identify securities within the groups that we're interested in that are showing improving fundamental characteristics, good, getting better, with prices that would support that view. So it may be that we have a strong fundamental view on a company, but if in the near term price behavior doesn't support that view, it may be that we're missing something, or in the near term there's a challenge. And so the third piece of our process is probably the most important piece, and that's a very disciplined selling process. That's using stop losses on our underlying positions. It doesn't mean we get out right at the top, but if it pulls back enough to change the long-term trend of a security or even the near-term trend, we'll look at trimming our position, have some liquidity so we can come back and fight another day. And as I think people know, we have a little liquidity in the portfolios currently, given what's going on in the market. Okay, so breadth, what am I talking about? Over a period of time in a healthy market, more and more securities will participate in a rally. If it's a specific sector that we're looking at, the percentage of stocks within that sector and uptrends should be expanding. That's a healthy market. When breadth starts to deteriorate or the weaklings sell off first, and then the selling spreads to more and more securities, or in fact, more and more sectors, it causes us to pull in our horns. And we track this empirically. Our job is to do three things: is to find and identify the true market leadership and focus in those areas. We don't have to be everywhere. Look for change, new leadership to emerge, or old leadership to lose its footing, to see if we need to be repositioning portfolios, and we have to have an ability to sit on our hands from time to time. And over the last few weeks, it's been time to sit on our hands. On June the 7th, when we looked at our models, the breadth model for the NYSE was improving, and globally it was improving. Our short-term indicators, which track the percent of stocks trading above their 50-day moving averages, or the short-term trend, was improving in Canada, the US, and globally. The percent of stocks with positive weekly momentum was improving. The percent of stocks making new highs versus new lows was improving, and the percent of stocks trading above the 150-day moving average was improving. But that changed quickly in June. By June the 29th, all of our short-term and long-term indicators were negative. Now, in that webcast, we talked about the fact that the short-term data was getting very washed out, and that after an exceedingly difficult first half, we're likely to have some kind of a bounce in the early part of July. The percent of stocks trading of the 50-day moving average in the S&P 500 got to 2%, which historically is exceedingly low. When we went back and looked at the dates where percent of stocks above the 50-day moving average dropped to 2%, when we looked out 1 month, 3 months, 6 months, and 12 months later, in 3 of the 4 occasions, markets were significantly higher, meaning that we got a bounce. In the one occasion, October of 2008, it was negative going forward. So that leaves that possibility open. But then we have to compare the financial conditions today to what was going on then and say, does this line up? And our comment at that point was, well, it's not impossible, but it doesn't look like we have a banking crisis on our hands at this point. But we'll watch. So as we sit today, percent of stocks in the NYSE and uptrends has started to improve a little. Doesn't mean everywhere. It means certain groups and certain securities, the leaders. Percent of stocks globally in uptrends has improved over the last 2 weeks. Percent of stocks trading above the 50-day moving average came off those exceedingly low lows. Percent of stocks with positive weekly momentum improved. In fact, let's take a look at these. When we look at the percent of stocks in uptrends, this is a long-term picture going back to 2001. This is a percentage reading on the left-hand side. And when the percent got to a very low level, column of zeros means that number's falling. We got below 30%. Generally, we were getting pretty washed out. This is the end of the bear market in technology in 2003. We bottomed at 24%. In the 2008-9 financial crisis, breadth bottomed in October of 2008. And when the banks finally bottomed in March of 2009, actually some of the stocks in the market were behaving better. There were more stocks in uptrend at that point than there were in October of 2008, even though the market went on to fall quite a few percentage points between October and March. That was a complex bottom in a very significant bear market. This was a financial crisis. When we compare to other cyclical bear markets over the last few years, 2011-12 got to 28%, 2016 got to 20%, 2018, that fourth quarter of 2018 got to 14%. In 2020, in the COVID lows, it got 6%. And we recently got below 30 to 20% and turned higher. Now, I can't tell you whether this is a low that will hold, but generally when we get below 30%, they are significant. So it may well be we bounce here in July and August, and we retest in September, October. We may get a low here, and we may get an inflation start to come off the boil, financial conditions to change, and the Fed pivots to a more dovish policy. But all we can do is watch what's actually happening in the market, and breadth for the NYSE is starting to improve a little. When we look at the percent of stocks above the 50-day moving average, we got as low as 10% at the end of June. That's very similar to what happened in 2020 and in 2018-19. So again, we got to a low level, and that's showing some improvement. So it may well be we've put in a near-term low. Percent of stocks with positive weekly momentum hit a low of 18% in June, rallied, and when the market actually made its lower low, fewer stocks had negative momentum. And now 42% of stocks have positive weekly momentum. And percent of stocks making new highs or new lows, again, got to sort of very extreme levels. So these things are all encouraging, but we have to continue to put one foot in front of the other. Now we track this not just daily, but intraday. And I just want people to know this is not something that we visit once a week. We track this every day. So for instance, today, bullish percent for the NYSE started the day at 26%. It was up 0.3% over the course of the day, even though it was a weekday in the market, and is sitting at 26.26. It's improving in a column of X's. The NASDAQ is improving in a column of X's. The optionable universe, meaning the most liquid securities, is in a column of X's, meaning breadth is showing some small expansion. Percent of stocks in the NASDAQ 100 is improving. In fact, 50% of the stocks in the NASDAQ 100 have gone back into uptrends. Percent of stocks in the mid cap index and the small cap index. So we track this daily. Now we know that the first half was a particularly difficult first half. The S&P at one point was down 24.7%. And since that point in June, we've had 4 weeks, 1, 2, 3, 4 weeks where the market's a little higher. In fact, markets holding above the 150 week moving average. We'll see whether that holds. A couple of things that are positive: sentiment exceedingly washed out. You can't open a newspaper or watch a news broadcast without hearing about the imminent recession and the collapse of the housing market and all of the things that people are concerned about. And speculators have done a good job in positioning for what they think is going to be a problem. And generally, when people get really short the market, it means that there's not a lot of people out over their skis that need to do a lot of liquidation. So that's one encouraging thing. Now let's talk about leadership. Well, most people know that energy has been a significant, we're going to take our weight down, finish point pullback. To put a point on it, the XEG, which is the Canadian Oil Producers Index, is up 27% on the year at this point. But certainly the last 6 weeks, we've pulled back to the long-term moving average at the 200-day moving average. But this ETF would equate to trading better than 95% of all of the companies in the S&P 500 year to date. Now, we know that often you do get a pullback in demand when you get to a recession. But historically speaking, despite the concern that energy is cyclical and it is economically sensitive, when we look at the various crises over time, it tends to be that oil producers and integrateds outperform the market through those periods. COVID-19 was a outlier because, of course, all travel stopped. Materials. We've got to separate the tactical from the strategic. Strategically, materials are in a long-term uptrend. Tactically, they've had a very sharp pullback over the last 4 weeks. And certainly, we talked about the fact we had to take down some materials exposure. Now, from a long-term perspective, the metals and miners, for instance, put in a low in 2016, a higher low in 2020, broke out of the range that they were in over that long period of time, 8 years, and had a nice run. We've pulled right back into support. So in the near term, we need to see some repair work here before we add our exposure back. From a dividend paying perspective, this has been leadership for us over the course of the last 2 years. The FDL Dividend Leaders ETF is trading better than 80% of the companies in the S&P 500. It is down 9.8% from the highs, a far cry from 24% in the S&P. And if we were to look at it from the beginning of the year, it's down about 2%. But frankly, with a 3.4% dividend yield, if you do the total return, it's pretty close to break even so far in the year. So this group is, I think, a significant outperformer. Now, the Canadian equivalent, this is the Canadian income equity ETF, is down 1.5% of the year, certainly pulled back some over the last few weeks, trading now below the long-term moving averages. We did reduce some exposure here, but continues to significantly outperform the market, better than 82% of companies in the S&P. And when we look at the long-term trend of the dividend payers, certainly this continues to look quite favorable. So what's driving this? Well, consumer staples, which tend to be defensive, had strong rising relative strength versus the market all through the year. Certainly also the healthcare group, which has had very good relative strength, has been one group that we've added to over the last few weeks. And in particular, the pharmaceutical companies, relative strength greater than 80% of companies in the S&P, trading above the 200-day moving average. And then utilities. Notice that when the market bounced over the last 2 weeks, these groups really bounced. So portfolio managers looking for more defensive positioning. The XLU is up 8.2% over the last 17 days. And certainly the pharma group was up sharply, as was the healthcare group. So these look as though they continue to be leadership to us. Nothing is risk-free. Nothing is a free ride, but we're getting a pretty good dividend and we're getting very resilient price behavior versus the market. When we put the two together, the dividend paying commodity producers certainly down 22% off the highs, but on the year down 3.8% versus the S&P down over 20%. Other groups that make up smaller parts of our portfolio. Within financials, insurance has maintained a strong relative price behavior versus the market and a good dividend payers. The aerospace and defense group, for obvious reasons, are seeing very strong demand and have strong relative performance. And now let's compare them to the other groups that we're really not focused in. Not really seeing significant change in the relative price performance of large cap technology. We've seen a series of lower highs and lower lows. This is not yet reversed, so it continues to be one that we're very careful about. The communications sector, which includes companies like Facebook and Alphabet and the phone companies, continue to plumb lows from a relative strength perspective. a consumer discretionary, an obvious group that we want to be careful about if there is a risk of an economic slowdown, continues to really underperform, and financials continue to underperform. If we look at style, RPG, the S&P Pure Growth Index, down 35% on the year as of the end of June, up a little bit from there. On a relative basis, no real significant outperformance, continues to be choppy. And value down about 8% on the year, or 14% off the highs, outperforming. Also, though, has backed off some, but certainly being a lot more defensive. So leadership doesn't look like it's changing much. Probably it has something to do with the fact that growth stocks still are relatively expensive versus the long-term average. Inflation protected or inflation beneficiaries continue to be fairly cheap, although there is some concern about how their earnings might act in the face of higher costs and some lower commodity prices. And the TSX continues to outperform. It's down about 11% on the year, and certainly outperforming the S&P. So Canada probably a little more interesting to us. And probably for this reason, the multiple on the TSX, when we look at forward earnings, is about 11 times earnings. If we go back over time and compare that to other periods, pretty favorable, so long as earnings continue to act okay. The S&P's pulled back from a multiple perspective, but not to the same extent. So we've seen multiple compression in both markets. That is, investors prepared to pay less for future earnings. And it's not just because they're worried, it's because they think that there is greater risk that companies don't make their expectations. And that's what makes this earnings period very, very important in the commentary that we hear from companies over the next couple of weeks, something we want to focus on. One thing that has changed is after very significant underperformance by bonds, since early part of May, we've seen good, strong outperformance versus equities, again, tactical versus long-term or strategic. But this has been a good place to take liquid capital and put it to work and wait for our opportunity once we see significant positive change in equities. So let's sum it all up. Across our portfolio, as opposed to energy being a very significant overweight, it now makes up 15% of the firm's assets. It continues to be an overweight because we believe structurally it continues to be a favorable group, but in the near term, it's vulnerable to a slower economic environment and negative sentiment. We do think structurally that there is a shortage of supply in the world, and it's going to be very difficult to overcome that in the near term, but we recognize that sentiment can weigh on prices. Government bonds are now our largest weight at almost 27% of firm assets. But to be clear, they tend to be short-term bonds. In our macro portfolio, we do have some long-term bonds because we think that there is a weakening economic environment, an opportunity to have a rally there. Consumer staples, healthcare and utilities, the dividend payers make up the next three groups. Industrials, which is specifically defense, about 6% of our assets. Communication services, specifically more around telecom, we've added a little bit for the dividend exposure, and cash remains about 5%. So between cash and bonds, it's about 30% of the portfolios. We add in corporate bonds, 35%, and then small weightings, near-term defensive materials, financials, and continue to underweight or almost exclusively have no weight in technology, consumer discretionary, and real estate. So this portfolio is a living, breathing thing. We have to revisit it every day. We can't see the future. We have to use the tools that we have to factor the odds and to make sure that the portfolios are in tune with what's going on. Things happening outside of North America, kind of interesting. Shanghai bullish percent hit a low in April after a 38% pullback from 2019 through the spring of this year. And we have seen a significant improvement in breadth there. We have a 10% weight in our macro portfolio because this reversal is very similar to the reversal in 2018. And very similar to the reversal in 2016, each one rallied the market fairly significantly. There's the ASHR ETF, which bottomed in April and then again in the beginning of May. It's been moving higher since. Japan is another outlier, a country where they've been trying to create inflation for 40 years. So this market is probably about the best performing market year to date. And we have about a 5% weight here. Japan bullish percent has been making a series of higher highs and higher lows since the early part of this year. So the last thing I want to talk about is in the near term, we have to focus on what comes out of earnings. We've come through the quiet period, and in the quiet period, everybody worries. What is it that we don't know? What is it that might be changing? Companies aren't talking because they're leading up to their earnings report. The expectation going into the period is that the average company will grow their sales and earnings this quarter, but we want to know what happens next. Consensus is that there will be for the second quarter of this year about a 5.5% increase in earnings. So third quarter is expected to be 10%. We're going to see what this is, the second quarter, and we're going to hear about what companies think might happen in third and fourth quarter. We may get some revisions lower here. As it turns out, just in the beginning of the quarter, only 17 companies reported, but the average sales growth is 9% and earnings growth is 11%. So that's well in excess of expectation so far, but it's too early to read anything into it because it's 17 companies out of 500. What is interesting is the path of earnings revisions coming into the quarter. This is the historical way that analysts revise going into the beginning of the quarter. And actually revisions have been a little bit less aggressive negatively going into this quarter. And the path of consensus 2022 EPS estimates has been pretty constantly higher. We'll see whether that comes down substantially. If revisions aren't aggressively taken lower, and if earnings come in at or around or a little ahead of expectation, then maybe the market can handle this and work its way a little higher. But let's be clear, a 25% pullback in the S&P does not mean that people are just starting to think about recession. They've been thinking about it over the last number of months. Now, remember that in the early 1950s, at the end of the Second World War, we had a bout of inflation where inflation went to 6% for 2 years. This was the beginning of a long-term bull market. The supply chain bottlenecks quickly came out, inflation dropped back down, and the market really moved higher. I want to raise this as a possibility as we go out over the next 2 years. If the near-term bottlenecks in the supply chain start to clear, and it doesn't have to be this month or next month, if consumer demand comes down a little and production catches up, we could get to a better equilibrium point. What we do know is that inflation expectations have started to come down. So tomorrow's CPI data is going to be important. It's backward looking, but the next few months are going to be really important. Last thing I want to touch on is the Treasury term spread. The 2-year to 10-year Treasury spread has turned negative. And that does tell you that people think that it's possible we have a recession. But again, I think this is significantly in the market already. Last piece of data I'll leave you with. The second quarter of 2022 was a 17% drop in share prices. If we take all of the quarters where the S&P dropped by 15% or more post Second World War, all of those felt bad. They included some really tough years like 1974 or 1987 or 2002 in the tech wreck, or 2008 in the financial crisis, 2020 in COVID lows. 1 quarter out, 1 half out, 1 year out, the average returns were pretty strong. So look, it's important not to get too bearish. I know that we read a lot of negative news. This is not a time to go and sell everything. If things start to get significantly worse, we'll certainly take it seriously. But in the near term, I think the portfolios are positioned well. So let's enjoy our summer. I think we are still in a structural bull market, and I know it's painful to watch the market pull back the way that it has over the last 6 months, but I think our exposures are defensive. We have lots of liquidity, and we'll ride this out like every other structural bull market correction. The last thing I want to leave you with is this. When we worry about something like 2008-9, we worry about a financial crisis. We can watch these changes in expectations in real time. We can watch the spreads or the extra return investors demand to buy a corporate credit. When they start to worry about credit risk, the extra return starts to go higher. And it has recently over the last 6 months. But let's compare it to what happened during COVID, something much sharper, or more importantly, what happens in a real credit crisis, 2008-9. So not to belittle this widening of credit spreads, we take it really seriously. But we're not in anything like March of 2020, and markets are pretty good after that. And it doesn't at this point look anything like 2008-9. Now, if it continues to worsen or our breadth models start to weaken again, we'll get more defensive. But as it sits right now, we've got really defensible holdings, and we got lots of liquidity, and we have lots of optionality. So if you've got any questions, I'm certainly happy to answer them. But you know, we have a propensity to get defensive in a tough market, and we're there now, and we can only take this day by day. So Pam, if there's any questions, happy to answer them.
Yes, David, we have 2 questions. Harry wants to know, David, if the market drops another 10%, would that change your mind about it being a bear market?
Yeah, look, you know, I'll show it to you this way. Let's see if I can pull this up. Okay, are you seeing my screen, Pam?
Yes.
Okay. So this crazy looking picture is a point and figure price chart of the S&P 500 going back to 2003. This period here, 2007 through 9, is the financial crisis. So we pulled back and we broke trend. And instead of finding a footing, had a second leg down, and it got worse. Now let's compare it to other pullbacks. So we have the significant correction in 2011. We broke trend, but found a footing and moved higher. We have the significant correction in 2015-16. We pulled back to trend and found a footing and moved higher. We have the very significant sell-off in 2020. We broke trend, found a footing, and moved higher. And this is the bear market that we've seen recently from the beginning of this year. We've broken trend. We're trying to bounce, and we'll see. Now, if we break the lows and move significantly lower, then we'll be opening our mind to it getting worse. But as it sits right now, our holdings are holding in quite well. And this looks a lot like a structural bull market, bear market. So, you know, we have to take them day by day. We have to go group by group. If oil breaks $94, you'll see us reduce our energy weight some more. If the dividend payers start to break down, which have been so defensive, we'll raise more cash. If breadth overall starts to weaken in Canada or the US or globally, again, we'll get more defensive. So the market is made up of moving pieces. It's a giant tapestry. We got to understand how they all work together. But so far, this doesn't look anything like this. And it doesn't happen overnight. This took from 2007 through March of 2009. We've been through 6 months. Let's watch it. I'm going to make a bet that if the economic data really starts to cool, and right now the market has baked in a recession, the Fed's going to become pretty dovish pretty quickly. And so we don't see signs of a financial crisis at this point. The credit default swaps don't look anything like they looked in 2008-9. Now, things that we worry about. The US dollar is very strong versus world currencies. We have to watch that. We have to watch credit spreads. We have to watch the earnings report. We have to watch the earnings commentary. We have to watch the earnings revision. There's lots of data still to come. But at this point, I think we're in pretty good shape.
Thank you, David. The last question we have here is regarding technology. And this viewer wants to know whether you see an opportunity coming in the technology space as we see interest rates potentially having topped.
Yeah, I mean, it's possible. It's possible. But as I said before, I think that structurally we are into a more reflationary period than a disinflationary period. Tech did really well because we had falling rates, not for like short periods of time, but extended periods of time, which meant investors were prepared to pay a higher and higher and higher multiple along the way. I think that there are some amazing companies in technology, but I do not think that we're in the kind of market where it's the only game in town. And it's still, as we said or showed earlier, relatively expensive versus the more inflation trade. But the inflation trade is taking a back seat right now as the Fed is hiking rates. So we're going to have to keep addressing that. But, you know, one thing that does sort of bother me is that semiconductors, which are a very important part of the market, this is the semi group, really can't seem to find a footing. You know, companies like NVIDIA, which have led the market over time, you know, just don't seem to be able to really find a footing. So we'll watch for it. And if we start to see it, then we can add some positions. But at this point, we prefer the market to prove it to us.
Thank you, David. Well, a very thorough overview as always. We missed you last week and appreciate the fact that you were able to come on and provide us with a great overview again. So with that, I leave you with the final word.
Yeah, look, I wish we all had a crystal ball. Bernard Baruch had a list of 10 sayings. One of his sayings was, all wishful thinking must be banished. You know, we just have to take information as it comes. And try to make sure that we factor risk against the reward that we're looking for. Right now, we think that yield is something that's worth getting. We've talked about now for the last year that dividends and dividend growth we think are going to be really, really attractive in a world where, you know, we have a little bit of inflation, and companies that have pricing power can raise dividends. And so far, they are being treated much better than the average stock in the market, and so we find that encouraging. So let's hope everybody can enjoy their summer. You know, remember that the tech stocks have now been correcting for 18 months. So they've come off a lot. And, you know, it may well be that rallies get sold because a lot of people are underwater on their positions, but that's okay. Markets find a way to get through a bottoming period, and maybe we're 2 or 3 months away, but my guess is most of the work that the market had to do to correct has been done. Now we'll look for signs that things are starting to get better. I think the moment the market sniffs that the Fed might pivot to a more easy policy, and I think that they would do that if we got some really, really weak economic data, you know, the market would likely take off way in advance of an improvement in the economy. So let's not think that we have to wait to the end of a recession to start having an opportunity. If the market senses that we're in a recession and that the Fed might pivot, you would get an easing of policy, and easier financial conditions would likely mean asset prices work their way higher. Thanks everybody for tuning in. We'll look forward to seeing you next week. If you've got questions we didn't answer, give us a call. Happy to talk to you directly. If you are a client, set up something through one of the counselors, and I'm happy to jump on at any point. I know Greg is as well. And if you're not, and you've got some questions you'd love answered anyway, shoot us a message and we'll have a chat. Thanks very much, Owen.
Thanks, Dave.